Fundamental analysis of a business involves analyzing its financial statements and health, its management and competitive advantages, and its competitors and markets. When applied to futures and forex, it focuses on the overall state of the economy, and considers factors including interest rates, production, earnings, employment, GDP, housing, manufacturing and management. When analyzing a stock, futures contract, or currency using fundamental analysis, there are two basic approaches one can use: bottom-up analysis and top-down analysis. The term is used to distinguish such analysis from other types of investment analysis, such as quantitative analysis and technical analysis. Fundamental analysis is performed on historical and present data, but with the goal of making financial forecasts. There are several possible objectives: to conduct a company stock valuation and predict its probable price evolution, to make a projection on its business performance, to evaluate its management and make internal business decisions, to calculate its credit risk. Two analytical models: when the objective of the analysis is to determine what stock to buy and at what price, there are two basic methodologies. Fundamental analysis maintains that markets may misprice a security in the short run but that the correct price will eventually be reached. Profits can be made by purchasing the mispriced security and then waiting for the market to recognize its mistake, and reprice the security. Technical analysis maintains that all information is reflected already in the stock price. Trends are your friend and sentiment changes predate and predict trend changes. Investors' emotional responses to price movements lead to recognizable price chart patterns. Technical analysis does not care what the value of a stock is. Their price predictions are only extrapolations from historical price patterns. Investors can use any or all of these different but somewhat complementary methods for stock picking. For example, many fundamental investors use technicals for deciding entry and exit points. Many technical investors use fundamentals to limit their universe of possible stock to good companies. The choice of stock analysis is determined by the investor's belief in the different paradigms for how the stock market works. See the discussions at efficient market hypothesis, random walk hypothesis, capital asset pricing model, Fed model theory of equity valuation, market-based valuation, and behavioral finance. Fundamental analysis includes economic analysis, industry analysis, company analysis. On the basis of these three analyses, the intrinsic value of the shares are determined. This is considered as the true value of the share. If the intrinsic value is higher than the market price, it is recommended to buy the share. If it is equal to market price, hold the share, and if it is less than the market price, sell the shares. Used by different portfolio styles. Investors may use fundamental analysis within different portfolio management styles. Buy and hold. Investors believe that latching on to good businesses allows the investor's asset to grow with the business. Fundamental analysis lets them find good companies, so they lower their risk and probability of wipeout. Managers may use fundamental analysis to correctly value good and bad companies. Eventually, bad companies' stock goes up and down, creating opportunities for profits. Managers may also consider the economic cycle in determining whether conditions are right to buy fundamentally suitable companies. Contrarian investors distinguish in the short run, the market is a voting machine, not a weighing machine. Fundamental analysis allows you to make your own decision on value, and ignore the market. Value investors restrict their attention to undervalued companies, believing that it's hard to fall out of a ditch. The value comes from fundamental analysis. Managers may use fundamental analysis to determine future growth rates for buying high-priced growth stocks. Managers may also include fundamental factors along with technical factors into computer models. Top-down and bottom-up, investors can use either a top-down or bottom-up approach. The top-down investor starts his or her analysis with global economics, including both international and national economic indicators, such as GDP growth rates, inflation, interest rates, exchange rates, productivity, and energy prices. He or she narrows his or her search down to regional industry analysis of total sales, price levels, the effects of competing products, foreign competition, and entry or exit from the industry. Only then does he or she narrow his or her search to the best business in that area. The bottom-up investor starts with specific businesses, regardless of their industry region. Procedures: the analysis of a business health starts with financial statement analysis that includes ratios. It looks at dividends paid, operating cash flow, new equity issues and capital financing. The earnings estimates and growth rate projections published widely by Thomson Reuters and others can be considered either fundamental or technical based on your perception of their validity. The determined growth rates and risk levels are used in various valuation models. The foremost is the discounted cash flow model, which calculates the present value of the future dividends received by the investor, along with the eventual sale price. Earnings of the company, or cash flows of the company. The amount of debt also is a major consideration in determining a company's health. It can be quickly assessed using the debt-to-equity ratio and the current ratio. The simple model commonly used is the P/E ratio. Implicit in this model of a perpetual annuity is that the flip of the P/E is the discount rate appropriate to the risk of the business. The multiple accepted is adjusted for expected growth. Growth estimates are incorporated into the PEG ratio. Its validity depends on the length of time analysts think the growth will continue. IGAR models can be used to impute expected changes in growth from current PE and historical growth rates for the stocks relative to a comparison index. Computer modeling of stock prices has now replaced much of the subjective interpretation of fundamental data in the industry. Since about year 2000, with the power of computers to crunch vast quantities of data, a new career has been invented. At some funds the managers' decisions have been replaced by proprietary mathematical models. Criticisms: economists such as Burton Malkiel suggest that neither fundamental analysis nor technical analysis is useful in outperforming the markets. See also, lists of valuation topics, stock picking, security analysis, stock selection criterion, John Burr Williams, theory, mosaic theory, Shepakovich valuation model, references. External links: MIT Financial Management Course Notes, Fundamental Stock Valuation Calculator by PE Values.